Well, welcome everybody, and thank you for being here. I'm Bonnie Halper. I write the weekly Startup One Step newsletter covering technology. I also help founders with their pitch decks and executive summaries, and I even do writing as well. I'll put my contact information in the chat. And so happy to have Jonathan Hakakian back. It's been years. But first, I'd like to Joseph co-hosts with me. And Joseph, tell us about you.
Thank you, Bonnie. Welcome, everyone. Good morning. My name is Joseph Katz. I'm a marketing guy. I work with a lot of startups over the years. I help early stage companies go from unknown to well-known using strategic marketing, go-to-market planning, and customer acquisition strategies. Happy to talk offline with anyone. I'll put my information in the chat. I encourage everyone to do the same for their information, and looking forward to today's conversation.
Wow. So, Jonathan, you have a choice. Either we go around the room and we have the participants introduce themselves, or you can start. You can start off and tell us about you and about the fund and your background, and it's up to you.
Well, I think just getting a little bit of context from the room on, how they ended up here, how they fit into the startup venture ecosystem, so that would help to know
Exactly
where people are coming from and set some of the context for me.
All right, totally agree. So, Ian, take it away.
Well, hi, everybody. Good morning. Ian Garmace. I'm based in Toronto. I'm currently COO of Virtual Film School, which is based in Los Angeles. And we are a live online school for aspiring influencers. And my comment on the election is we have met the enemy and he is us.
Thank you for that. Andrea, always good to see you. Even though you're muted, I don't know if I know she was traveling. She was trying to get to a good spot. I guess she hasn't found it yet. Igor.
Hi, everyone. And Bonnie, thanks again for inviting me and hosting these. Always amazing. I'm Igor. I'm the founder at Roya. The world's leading brands use our platform to allocate spending across online, offline promotions. We partner with VCs focused on DTC and CPG brands, some of the world's largest media agencies, and functionally, we answer the questions that no other analytics firm can answer, like how much are we getting back from billboards and what's our playbook for increasing our revenues.
Yes, in fact, I'd like to introduce you to Igor because I know you do consumer products, Jonathan. Joe. Joe is a frequent speaker at our breakfast, our online events. We used to call them investor breakfasts.
Yeah, Joe Milam out in Austin, Texas. 11 years now, came from Northern California. Ran a multifamily office for 20 years and was kind of a finance nerd and researching and applying sort of systematic, some people call it quant, although we weren't high frequency traders, so it was taxable old money was our history. So it was, but very much a process driven investment firm. And we happened to be there in the middle of Menlo Park. So I got early exposure to the venture world and got active in the earliest angel groups that sprung up in the mid 90s and saw really the absence of real investment process to how people, the decision making and the portfolio architecture and the capital deployment and the risk management and all the things that are kind of standard practices in the public market. So we built a platform to bring what I would say, and now others are saying, is long overdue innovation and how we fund innovation by bringing, again, long overdue, applying the research I've accumulated over almost 30 years that's been done on how, if you could whiteboard a venture fund, start from scratch, not just do it the way everybody's always done it, because that's the way everybody's done it, but actually take a design thinking approach to the venture fund model. We built it.
Okay, thank you. Ken. Oh, Ken, you're muted. I wonder if he stepped away. Lon, you want to introduce yourself? Oh, there we go.
Good morning, Ken Deering, CEO, co-founder of Vigard Home Solutions from Seattle. We are a insurtech solution. We help homeowner insurers and long-term care insurers by preventing the #1 cause of residential fires, which is forgotten cooking. For long-term care insurers, we act as an age tech solution because we enable older adults to safely remain in their homes years longer than they have typically been able to. Thanks.
Oh, thank you. Lon, you're muted as well.
Good morning, everybody. I'm Lon Taylor. I run a company called First Insights, which is a boutique market research company specializing in user experience research. So things that we do are usability testing, focus groups, ethnographic research. My background is having worked for a large digital ad agency years ago that Bonnie helped me get into. And before that, if you want to talk politics, I taught history and I have a political science degree, so you could do that offline.
Yeah, we can. We'll do a separate.
I
one
also,
for that.
yeah, I also mentor a bunch of startups for a program in Chicago and a program down in South Florida where I am currently living.
Thank you. Scott.
Good morning, Scott Purdy, one of the founders of Sine. What we do is we have a program that will take multiple inputs of videos from anywhere, really pretty much anywhere in the world, and our product will take all of them and hopefully using AI to properly pick how we tell it to do, we'll make a final ending movie in a very, very short time. So instead of having like an editor go back, edit all the videos together and string them together, this will just be done in an extremely short time. I also am a part-time actor, and I've actually been getting a lot of stuff recently. And in a previous life, I worked 26 years at a college that I ran the online distance learning program with all the online courses, hybrid courses. So, and I did most of the technical stuff for that. So, done a lot of different things, including cleaning toilets at one point in time. So, until you've cleaned the toilet, you haven't done anything.
Well, but have you served fries at McDonald's? That's the real question these days.
I don't know if I'm qualified for that.
Okay. Oh, well, then you'll never be president. I'm sorry. So,
Ah,
Andrea,
wouldn't want to be.
Me neither. I guess Andrea is still out of pocket. Andrea is a recovering lawyer who is an investor. She works with a family office. So, Jonathan, take it away. Tell us about you. Tell us about the fund.
I'm excited to. So it's funny, Ken, I think we just screened your company this past week.
Yes.
But don't ask me exactly what my follow-up questions are because it's so many pitch decks ago. It's all jumbled in my head. So,
Veronica said, I think today or tomorrow, she's scheduling both the larger meeting and then the one-on-one with yourself.
Yeah. That was what I thought, but I didn't want to commit to that without being able to confirm with her. She's actually been out this week. She's moving.
Right.
So we've given her the grace to follow up on everything next week. But
Okay.
yeah, it was very interesting to see the way you're approaching the market and what you guys have built and done.
Thank you.
That's one connection here. And I'll clarify, Bonnie, we've come a long way over the last 12 years since we launched our first fund. When we did, what was it? Joe, to your point, we built our VC model totally by accident and probably backwards because we didn't come from other funds. We sort of ended up here because we saw that there was a niche and value in the market to do what we were doing at the time, and I'll share that in a sec. And when we set out, we wanted to do consumer goods because we thought that we had the expertise and experience to do so. We wanted to do ed tech, and there were a couple other areas. And over the last 12 years, we realized that's not really our focus. Our focus is we really have to get to know the people. And so our diligence process reflects getting to know the team and the people more than just sitting on Zoom. We actually leverage a series of assessments that my partners packaged together over the last 25 years. He's been in leadership development. So we have a data set plus our anecdotal gut, and we kind of looked at the subjective and objective data points together to make sure that we resonate with the founder and the founder resonates with us. So one of the areas that we thought we would do is consumer products, but we realized we're really bad at that. There are much better investors out there where they have deeper pockets, larger influencer networks that can really support the growth and scale that build a brand. So you are right. That's where we originally intended, but we've moved away. We've learned a lot over the last 12 years. So I'll back up and give a quick background. Is that what you'd like, Bonnie?
Yes.
So as Bonnie mentioned, co-founder of SoundBoard Venture Fund, we launched our first fund in 2012 in a very specific way to not focus on the Bay Area at the time. So back in that time frame, we saw that New York and New York metro area, the tech startup scene was starting. It was not nowhere near where it is today. It was still in its infancy. I'm sure, Bonnie, you remember the meetup groups were giving away pizza and beer just to get 25 people in the room.
Yeah.
So it was a very different time in the landscape. A lot of fun, a lot of activity was just percolating and starting. And we saw that there was a need to bring incredibly talented entrepreneurs and get support from executives, CEOs, entrepreneurs who had built long-lasting businesses and bring them together for advisory and mentorship. And what we realized very quickly was this is great. Like they love the advice, but there's no business model here because what the companies really need first and foremost is funding. And this is between 2010 and 2012. And so in 2012, we said, we're launching a fund, and we launched our first fund, and we're small investors. We're not the big Andreessens or primary venture funds. Like we're not that big. We're still small. We like to fly under the radar a bit. So we launched our first one with this very unique approach where it was very collaborative with all of our investors. So our investors actually, they make up, even today, second fund, they make up our screening committee, they make up our diligence team so that we're allowed to go broad in terms of industry set, but we're not deep tech investors. We don't go into the next generation of virtual reality or the next generation of AI. We go into real business implementation of these technologies that solve real world problems. And we found that this is really where our niche lands. And over time, what we've also evolved is we were focused on New York back in 2012 because it was an overlooked market for tech. As it's grown and become number 2 in the country and quite possibly in the top 10 or 15 in the world, we feel like there's enough focus here. There are great opportunities for entrepreneurs elsewhere. So instead of being 75-80% focus on New York, it's probably at this point it's probably 30-40% New York focused and 60% other areas of the country. We've invested in St. Louis, in Virginia, in Chicago, somewhere in Florida that's not Miami. So we do look for these other pockets of startup and venture talent. I can keep talking, Bonnie, but I want to make sure that I'm getting the question to the heart of what the group here wants to know.
Yeah, we always open it up to questions. So since you're not CPG focused and you're not deep tech focused, where do you like to put a focus, or where are you primarily focused?
So we don't do anything in the consumer or brand space, and under that is consumer products, consumer software, crypto, social, and gaming. Because again, all those entrepreneurs have tougher metal than I do. They're building big brands because that's what it takes in order to get the consumer adoption. And there are much better investors, as I mentioned, who have that influencer relationship that they can help plug in the company into. And then we also don't do anything in the life science world. So nothing in med tech, bio, nothing that requires 510(k) regulatory approval. So right down the middle ends up being B2B, B2B2C. We'll do hardware, we'll do software. Again, it's not a science fair project. It's not like this is what AI is going to be in 10 years. It's, hey, this is a real business problem. We've developed a solution. We have a couple pilot customers or demos or clients lined up. That's sort of where we go. If you look on our website, all of our portfolio companies are listed there, and it can give a little bit of a outline of what types of companies in more detail. Again, we do go across industries. So in the past year, we've done hardware for the oil and gas space. We've done the bonus solution for HR tech. We've done what else have we done that's recent? we're in diligence with a company that's doing infrastructure for bikes and bike parking. So those are the kind of things, just to give you an example of what we can do or have done.
Okay, thank you. So questions. It's always questions, and Ian is usually.
Well, yeah, so Jonathan, you mentioned a number of areas, but I mean, would you say that all of those projects that you're invested in are kind of venture scale? In the sense that they could grow like to a huge extent in a moderate amount of time?
So that's a deeper question than yes or no, Ian. As a small fund, we don't need to have the giant $10-20 billion companies in order to see success or realize what we define as success.
Mm-hmm.
We still do need venture scale returns that's a 20, 30, 40x multiple. But because we're going in very early, 5 to 10 million pre-money valuations, we're going into companies that because they're leveraging technology, they don't need to raise tens or hundreds of millions of dollars to get to scale and exit. So there's less dilution. They can still sell for $200, $300 million, and they may never make front page of Wall Street Journal or the a key headline in TechCrunch. But the entrepreneur is happy, my investors are happy, I get to raise my next fund. So they still do have scalability, but not in the West Coast definition of Snapchat, Facebook, Uber, Google. And that's okay. And that's sort of how we've benchmarked the companies that our fund is, we'd rather go for those companies that are under the radar. They don't need to go IPO, but hey, if they do, nobody's going to complain.
Right. And would you say that most of them have deep technology of some sort?
They all have a proprietary layer that's scalable. Their technology is unique to them, and part of the critical reason why we believe that they're going to win in the market.
Got it. That's
but
great.
It's not all deep tech. Yeah. Yes, Eric.
Oh, I forgot one. I was going to say, Eric. Yes, Eric has to introduce himself, and my apologies. I said I woke up with a terrible head cold, but go ahead.
That's fine. Thank you, Bonnie. We only talk like every other day, and you forget me. But Joe does that a lot too. So, I'm the founder and the CEO of Millimatch. So let me kill two birds with one stone here. So, Jonathan, I'm curious. My question is, how do you were talking about get to know the people in the team, and so how do you know the founder and the team have the soft skills or the behaviors to execute on their plan, and not just to get through the first stage, but the next few stages in a startup? And it may seem like a loaded question, but it's one that Millimatch has grappled with and kind of solved. So I'm curious from your standpoint, how y'all do that?
Eric, so are you saying that Millimatch, you guys are trying to address this internally, or this is part of the technology you're building is to understand the team dynamics?
What perked my ears up is when you said it was very important that you all know the team and the leaders of the company, and I think it's important too. But I've been on the other end with 5 previous startups to where they just made some quick assumptions and snapshots, and that was it. They really didn't want to know us unless we were part of their portfolio. But what I heard from you is that you're different, and I applaud that. I was just curious about how do you go about differentiating that? I mean, what's your approach?
So I am not the fastest check in the West, Eric, and I don't claim to be. When we meet entrepreneurs, I let them know up front, this is a two-way street. They've got to get to know us, and we've got to get to know them, because the industry stats show that it's more difficult to get out of an early stage opportunity or an investment than it is to get divorced in the United States.
Yep, true.
So,
Yep.
and most angel investments or early stage investments last longer than most U.S. marriages at this point.
Yep.
So we need to be dating for a while. Even though I'm a small check, I want to make sure that we are aligned on a lot of things. And the only way to do that is to spend time together. Now, in the pre-COVID, pre-Zoom world, it would, be a couple meetings, but really would culminate with like that old school full day whiteboard session where everybody's in a room together. There are papers flying everywhere. The whiteboard has all different colors on it. You leave exhausted, but you really got to know each other. In Zoom days, I can't keep people on the phone for more than an hour and a half tops. On the Zoom, more than 90 minutes before they check out. And it's very easy to kind of hide, like you don't see all the chaos that's going on around me right now. It's easy to hide that on Zoom. So the way we like to do it is, once we enter diligence, we have 3 or 4 hour-long discussions that are very topic-driven with the entrepreneur or the team. Different times of day, different days of the week, and it gives us a sense of their psyche because they're going through different things every week. It's not all like, okay, they can pretty it up and put everything aside for 3 hours. Like, no, business is still going on, on week 1 and week 3. So like they've got to manage it through. So we kind of hear their different stresses and hear what's going on. And we're able to track like how have they been able to develop the business over 3, 4, 5, 6 weeks of time. Like what are the milestones they said they were going to hit, even if there was, small, but did they say it and did they do it and what happened? So one is that's just the gut side of it, getting to know people like as people. On the other side of it is we have my partner's had 25 years in leadership development. He started a consulting firm in 2000 focused on leadership development, management consulting for entrepreneurial-led businesses, but at the mature stage. So instead of the startups that we're talking about, Richard's been focused on working with family businesses, small, medium-sized businesses that they want to achieve that next milestone in their career. Now, whether that's exit, investment by PE, or getting the founders to a comfortable level where they can not work 90 hours a week. Whatever that milestone is, he had been working with them for a decade plus before he and I partnered together and started our first fund. And what we've done is we've brought that level of insight into the diligence process through leveraging a series of assessments that analyze the individuals, how they show up to work, what motivates them, what drives them, why are they doing this, what are they passionate about on the individual level, and then as a team. And Eric, it's not to sit there and point fingers and be like, well, this is missing, that's missing. Like, no startup is going to have a complete team on day one.
That's sure enough, yeah.
But it's about how does that conversation happen? How does, do they sit back and say like, no, that's bogus, I don't believe in the assessments, it's false? Or do the entrepreneurs sit there and be like, you know what, that's valid data. I'm going to park it in the back of my head. Maybe it's relevant now. Maybe it's relevant in a year from now. But it's good information and a reflection of who I am and who the people around me are. And maybe there's nothing I can do about it today. But yeah, you know what? I saw that, my co-founder does operate like that. And maybe I should adjust the way that I approach problems with him. So that's what's important. It's not the data, like specifically, because the data is just data. Like it's all about what we do with it. All right, I interrupted you. Go ahead.
No. See, I founded Millimatch because number one, I founded Millimatch to take and identify the potential in people, whether it was known or unknown to them, and also to take and look how that potential applies to specific positions, roles, and everything else. So in essence, what boggled my mind, and I could have made millions more and saved millions from my previous companies, if I would have had a tool that pretty much got at how do you identify the right people to put them on the right bus in the right seats doing the right things and so forth. And my previous background with Microsoft and all that, I took a lot of these tests, and what we did was took a 180-degree turn, as opposed to self-assessment, we came up with other technology, other science. I'd love to, I don't want to occupy your time on this,
Yeah.
but I'd love to show it to you, Jonathan,
Sure.
in a separate meeting.
Sure.
And I want to give Francesco, I got here late. Francesco, why don't you introduce yourself? He's been here before. Hey, you're muted right now. Or maybe
No.
he's an investor. Anyway, next question.
Yes, Scott.
Yeah, Jonathan, a couple things that you said. And can everybody hear me okay? I thought I was having some
Yes.
problem. Okay, great. Yeah. You said that you're more of a small fund. Do you have generally a range, part one and part two, when you're looking to invest, is there particular industries or technologies that you sort of gravitate to that you feel most comfortable working with?
So to answer part one, our target check is 250,000 into what we call the seed round of capital. Now, to me, that's the second round of capital that's come in, with the first round being friends, family, bootstrapping, hustle, business plan competition, grants, whatever it takes to get the company to a point where the founders are full-time, they're dedicated, they're pouring everything, their heart and soul into it. They're like, I've been able to demonstrate thought leadership in the industry. I've been able to bring a demo, a pilot, an alpha, a beta to a customer. So they've got like 2 or 3 feedback loops from the customer back to them so they know how to build the next iteration of the product. That's the earliest we would get involved. So, and I'm very vague on that, Scott, on purpose, because we do go across industries. So do we invest pre-revenue? Yes, but not always. Do we invest at pilot stage? Yes, but not always. Can it be pre-product, pre-finished product? Yes, but some other semblance of client validation does have to be. So usually that's the $1 to $2 million round, between 5 and 10 million pre-money valuation. We won't go above 15 post-money value. We put that as our hard cap. I think, Ian, to speak to your question from before, like one of the reasons why we do that is because we do expect our exits to be 100 to 300 million dollars. And in order for that to make sense, we need to get in at the right price. So I think that was your first question, Scott.
Yes.
Any follow-up related to our investment strategy on that?
No, thank you. That was great information. And then again, I was just curious because when I go on all these meetings, there's people in technology, medical fields, customer help, psychology, therapy that, same boat as us, looking for investments. And so I was wondering, is there something like, I know sometimes people gravitate towards things that either are important to them or that seem to make sense for them or they have experience. So I was just curious on like what areas that you may gravitate towards.
So to the discussion with Eric before, number one is amazing individuals and human beings. My day is sitting on Zoom and having coffee with really incredible people and listening to their unrealistic, passionate ideas. So I am always happy to give 15, 20 minutes to just an incredible person who just wants to tell me about how they're going to change the world. One of the key reasons I realized that I've gotten into this industry is I was on a train once. It was Amtrak going from New York to Boston. And the train stopped because some kids were playing chicken with the train, with the Amtrak. And so all of a sudden it's halted, like an hour delay until they figure out what's going on. And so, passengers started talking to each other. And there was a gentleman sitting next to me who was from Connecticut. His name was Nick Condon, and I've tried to find him because he sat there, and he was an older gentleman than me. This was probably about 15 years ago, and he was an angel investor, and he said, Jonathan, if somebody came to me and they told me that I can figure out a way to talk to dolphins, true story. He's like, I would sit down with that person. And I said, what? Why? That's like unreasonable. He's like, because what if they can? I was like, okay, like that's an interesting perspective. Like give everybody the 15, 20-minute shot and let them convince you one way or another. And so I crave being educated. Like this is the most humbling industry in the world because I am often wrong. I am not the smartest person in the room. And like if you look at the industry stats, it's 1 in 10 is going to make it. So most VCs are wrong, or even angel investors are wrong the vast majority of the time. To more specifically answer your question, Scott, so you have some semblance of what we invest in. We go into mainly understandable business and understandable industry. So we've done a lot of real estate and construction and prop tech. We've done a fair amount in the wearable space, again, B2B, not direct to consumer. We've done some insurtech deals. We've done some industrial materials. Again, we do have a few people who understand the sciences when it comes to materials, and more importantly than the science is the sales process, how to sell into or how to sell those products out to their respective client bases. We've done general software, a legal software, an HR software. Closed out the window. What we've done, but we've also, done things and realized we shouldn't be there. Like we've done diagnostics and realized this is not for us. We shouldn't touch that area. We don't have expertise. So I hope that gives you a little bit of a preview of what we like, Scott. And again, you can just check out the portfolio page on our website and click around to get a couple more.
No, thank you. It does. But on the one thing, I have found a way to talk to the birds and squirrels on my front porch. It's called bourbon. And we have some great conversations.
Awesome.
Eric.
Yeah, Jonathan, I'm curious, what is your style, or how do you work with your portfolio founders and leadership team? What is your involvement, or to what capacity? And I guess that's a general question, but I've seen all kinds, and I'm just curious whether yours is more of a get involved, hands-on, but I don't want to put words in your mouth.
So the way we approach it is that we are an investor, we're a minority shareholder, Eric, and what we want to do is at the end of diligence, when it's getting close, and again, our diligence process is not quick. We take the time, and every step of the way I'm working with the entrepreneur and telling them which direction we're going, because as soon as I see the pendulum swinging towards no, I cut them loose, because it's not fair to them to waste their time, and I don't want my time wasted. So if we keep moving forward in diligence, it's with the intention that we're getting closer to yes. So once we're at that point where we're like, yeah, we're going to make a commitment to the company, I sit down with the entrepreneur. I said, at this point, after 4, 5, 6, 7 weeks, you've gotten to know us, we've gotten to know you, you've met 5, 6, 7, 8, 10 people from SoundBoard. Who resonates with you as the entrepreneur to be our conduit? Now that can be a board member, an observer, an advisor, or at the very bare minimum, an hour-long phone call every 6 weeks for 18 months, which is approximately through the next fundraiser. And the reason why I structure it like that is because I don't expect that we're going to be the right fit to be on the board of every company. And it's not my job to sit there and tell the company, you have to do it our way. You have to put us on your board. We're an investor. Like, no, it doesn't work like that. We have done the diligence that we're trusting the entrepreneur's leadership, their direction. And what we want at base minimum is a phone call to continue building the relationship, to make sure that we know what direction the company is going in, and so the entrepreneur feels comfortable sharing the good, the bad, and the ugly. Because in startup world, 90% of the time, things are going to go sideways. I mean, those of you who are entrepreneurs are shaking your head like, yeah, but that's why we're in this. If everything was always going right, and everything was up and to the right and going great, everybody would be an entrepreneur. But it's because it's so hard and things hardly go right that we do this. And that's what the job of an investor is, to be an ear, to listen, and to advise where we can. If we can't advise, I say, like, look, I'm just going to listen, vent as much as you want. You're interrupting dinner, it better be important, but I trust that it is, because we've built the solid foundation during diligence that, we have respect for one another's time. Mm-hmm. So it's not a one size fits all, Eric. It's a very custom relationship that we build based on the expertise that we have, the network that we have. And again, if we don't have enough, like, okay, we don't have the right, if the board is full, you have all the advisors you need, just make sure you call us once, twice a quarter, give us the update, feel comfortable telling us what's going wrong, and we will support where we can, or like offer suggestions. That's it.
Jonathan, that was the most refreshing and genuine response I've gotten over 20 years. I cannot believe you.
Thank you. It's the way we operate. We don't see it doesn't work otherwise, because it's not my company. I have enough stuff going on in my life. I don't need to run, 20 portfolio companies. Thank you.
Ian, I'm just going in order.
Yeah, all right. Well, just quickly, I mean, I've spoken to a number of investors recently, and several of them mentioned the absence of dry powder, or the shortage of dry powder, in the sense that they have trouble finding limited partners. I mean, what is your situation in that respect?
So I think there's two ways to look at dry powder, Ian. The first way is funds are actually sitting on a good amount of capital, or at least they have been for the past year and a half, 2 years, because if we look back to mid-22, so you had the COVID months that everything shut down, then you had the COVID craziness through like end of 20 through 21, right into early 22. And I think it was April. And in my memory bank, I kind of pegged it to Ukraine war, and then oil prices and gas prices went a little crazy, and then the stock market started taking a hit. That's when the bottom fell out. And from that April, May of 22, probably until like earlier this year, so for a solid year and a half or maybe more, investors were not investing at the same clip as, forget the COVID craziness years, but 2019. And anecdotally, in the first 9 months that we started this fund, or in the first 12 months of this fund, we launched in May of 21. So from May of 21 until maybe July of 22, so maybe 14 months, we invested in 9 companies. Since then, in the 2 and change years since then, we've invested in 4. And it's not for lack of trying. It's a number of things happen. And so we are sitting on the cash, and it's annoying because I'm like, I signed up to invest. I want to invest, but we haven't been able to find the right fit of company and entrepreneur with our investment. And that's for a couple of reasons. And very quickly, because I want to make sure I get to the other questions you asked. There was a huge increase in entrepreneurship, like right 3-4 months into COVID. And so if you think about that time frame, that was October, November of 20, when people were, they were home, they were bored, they had extra money in their pocket, new challenges were coming up, they started companies. So if that's when they started companies, by mid-21 or 22 is when they were out fundraising. So you have the natural accretion of entrepreneurship year over year, single digits, I don't remember exactly how much. Then you have this incredible influx of entrepreneurs coming because of COVID. So that was all coming. And then in mid-22 and 23, once the bottom fell out and investors tightened their grip on their funds and they didn't invest as much, now all of a sudden all those companies that should have raised Series A couldn't raise Series A, so they went back down to seed. So for like 2 years, we had this incredible amount of companies that were in the seed and Series A space-ish, this, however you want to define that area. Again, natural growth of entrepreneurship, COVID influx of entrepreneurs, and then this Series A that couldn't raise. So it was really like there was a lot of companies, and it was difficult to suss them out. And I think that a lot of companies have probably gone out. I was telling a lot of entrepreneurs, if you can make it through 2023, like you will have your pick of great operators, because a lot of entrepreneurs were not going to make it through 2023. They didn't make it. So anybody who did, kudos to you all, because that was a very, very difficult year for entrepreneurs and startups. So on dry powder, I think funds still are sitting on cash that they want to deploy, because the pace at which was normal pre-COVID hasn't been the same pace. And then during those 2020 through 2022 years was insane. Like that investment pace and the entrepreneurial friendly terms that were given, unsustainable. And so now we're starting to get back to it where, investors are starting to invest more. Entrepreneurs are finding the right terms and the right matches much faster. So I think now that the funds are starting to invest a bit. LPs, they're not investing in venture funds right now. It's a very difficult. Now there are some, but to raise a fund in this environment has been very difficult. Maybe January will be different between it being a new year, economy's doing differently than it was at the beginning of this year, elections over, maybe it will be, but the biggest factor for early stage venture is the trickle down from IPOs to M&A to growth stage to early stage. So once the IPO markets open up a bit more and investors can see that there's light at the end of the liquidity tunnel, then LPs will get more excited about opening up their purse strings to room. That was a very long answer, Ian.
Oh,
Yeah.
no, that was great. You put
That's
everything.
great.
Yeah, I appreciate that. Thank you.
Oh, thank you. Joe? Joe? Oh, you're muted, Joe.
Yeah, there we go. This is just finance nerd question. So how many funds have you guys launched? What's been their performance? And third is, what's the typical architecture of your portfolios, your funds? How many holdings do you do follow on your existing holdings, stuff like that?
So for first fund ended up being 21 companies in the mix. We've had 2 very solid exits that have returned 50% of cash back to our LPs. We have a handful of companies that they didn't return all that much. I have a couple more that I've written off in my head, and that leaves about 6 companies that are still alive. And 3 of them are up and to the right. They're doing amazing. They're doing phenomenal. I'm just waiting for the exit environment to open up to have my win.
And that was the fund launched in 2012?
So that's one of the key learnings and so for us, that was our first fund, Joe. And we actually invested from 2012 through 2017. So it ended up being a 5-year investment horizon, which is very atypical for early stage investors and not something I would suggest because of this exact scenario where now we're in year 12, about to enter year 13. And some of our late companies that we invested in are still maturing. So I would have liked to have a couple more exits, but I'm not going to cut my nose to spite my face. I'm not going to push them to early exit when I know how big their opportunity is if I wait another year. But those 3 companies, they have significant revenues year over year. They've got bigger investors or major clients that I'm like, I am officially the small guy on the cap table and in the company. But I'm not going to make any guarantees to my LPs. It's all still high risk, high reward environment, but those 3 are looking very positive. So that was 2012 through 2017. In 2017, we realized that we didn't have the exits just yet to raise our second fund. So we transitioned into what's called an angel network. If you guys are familiar with it, great. If you want me to share a little bit more, I can about how it works. But an angel network as the lead person on it is an amazing experience, but way too much work without enough benefit. So we did that for about 1.5 years or so. We did, I think, 20-something deals in 1.5 years. We were very, very active, and I realized that I can't run the network while fundraising for Fund 2. It just wasn't, the time was not available. So we shut that down in 2019, officially launched fundraise for our second fund in September of 2019, got about $3-4 million of commitments before COVID hit. COVID put everything on pause for 6 months until and the craziest thing about our industry is that even though the entire venture world is so tech oriented and forward looking, none of us were ready to work from home. So it took us all several weeks or months to figure out, well, how are we going to work on Zoom and all of this. And then once it all figured out and things started shaking up again by September, October, then we were back up and running, and we ended up hitting our first close in May of 2021. And that's when we relaunched Fund 2. Fund 2 has 14 companies in it right now. We have 14 companies. I'm looking for about another 10 to 15 more at the 250K level. Follow-ons for us, because we're a small fund, are more symbolic than significant. And so we do put in 250, and that's our target check, into about a third of the opportunities. We could do up to another 100. But most of the time, what we do when it comes to the follow-ons is we actually create SPVs for our investors. So a lot of our LPs actually look to us and they say, well, if SoundBoard's going into the seed round, I'm putting such a sizable check for SoundBoard in, and I'm already an LP. Let's see how the company performs, and maybe I'll double down in the Series A or the Series B. And we've seen that that's where our investment model has been very, very effective, and the follow-ons have come. So, and I say our investment model because about twice a quarter we actually host what we call our investor meetings. So we bring the companies that are furthest in our pipeline to meet all of our LPs. They give standard 10-minute pitch, 15-minute Q&A, but of our 50 LPs, maybe 25 or 30 are on the line. They get to ask questions, they get to get involved, they get to really feel what we're investing in, and they've created and thereby they've created an emotional bond with the company, so that in a year after or 2 years after, the company comes in for an update. And then following that, another 6 months or a year after that, they're like, okay, now we're raising our Series A. The investors have been able to say, well, SoundBoard's been in it since the beginning. We've seen the entrepreneur several times. They've said, this is what we're going to do. This is what they did. These are the milestones they've achieved. Okay, it's de-risked. I'm ready to put more in. So that's how we've seen it work often. Did I hit all your questions, Joe?
Yep, thank you.
Oh, thank you. Lon.
So yeah, I'm involved with two different sort of mentor programs, one in South Florida through Florida Atlantic University and another in Chicago called 1871. I'm curious what your thoughts are on having the companies that you're working with participate in those programs. Do you really see that there's tons of value? Is there not much value? Just wanted to get your thoughts on that.
So I've heard of 1871, Lon. I don't know the Florida one, but I won't speak about any specific program. Is that okay?
Yeah, just big picture like in general, like you push the companies that you're working with to participate in those, could be Techstars, there's a whole bunch of them.
So when it comes to mentorship accelerators or programs like that, my suggestion to entrepreneurs always is you have to be very specific and purposeful. There has to be a reason why you're going and whether you're spending time or spending equity into that program. So there are a lot of great business accelerators that an entrepreneur with a great idea needs some initial setup help to get from concept stage to wireframes, or they need help in how to pitch to investors. Like they've got to go in and work the network and work the program. Because if they just say like, yeah, I've been part of this program and this program, well, like why? What did those programs add to the business? Like, why did you do them? I don't just want to see a bunch of logos on a page like the Verizon Accelerator, and then I did, this university incubator, and I'm part of that mentorship program. But what's the purpose? Why are you not, like, how does that move the business forward? And so I don't think that it's smart when entrepreneurs hop from accelerator to accelerator. Several have actually asked us, like, should we do this? Should we do that? And I've said, really, you're allowed 2 accelerator programs because they usually take, a couple percentage points of equity, up to 7, I think is the top. You're allowed like a business one that helps get you off the ground, and then you're allowed an industry specific one. If you keep moving from accelerator to accelerator, now all of a sudden how many accelerators own 15-20% of your company? And again, for what purpose? So it's got to be the entrepreneurs who do well in those kind of programs. They go in with an agenda of what they want to get out of it, of how they're going to work the program.
Yeah, no, that's very much appreciated. So,
Oh, thank you.
Jonathan, are you you a New Jersey guy?
Yes, I am.
Okay. Yeah, I'm exit 3, Turnpike. It's like right
A
off
little
the
bit
exit.
higher. Yeah.
Yeah, I know. Yeah. Actually, I'm the bridge right under the Turnpike. That's where I usually am at. But unless I can get a friend to let me sleep on their couch. But all right, no, thank you.
That's a part-time actor way to do it.
Yeah.
So after you figured out the Zoom model and how to work under that, are you working remotely in office, hybrid, Jonathan?
Mostly, yeah. I probably go into the city 2-3 times a month, mainly centered around the events and conferences. Like ERA Demo Day, Bonnie, those kind of things that sort of anchor the day. Otherwise, it's become incredibly more efficient to take the 20-30 minute intro calls on Zoom, where I can go one from the other, and just I'm exhausted by 1 o'clock in the afternoon, but I've gotten as many meetings as I could if I was in person.
Okay. So next question. Do you have any more questions from the
Yeah,
room?
I have one.
Yes.
Yeah, I mean, how do you discover companies that you might want to invest in? I mean, some companies like Laconia, like they have a team of co-op team members. And what is your method for discovering opportunities?
Laconia is great. I've known
Yeah.
Jerry for a while.
Yeah.
She's good people. Ours is we've just been working in our lane for 12 years. Yeah. So we've got a good network within entrepreneurs, within to the previous question, the accelerator and incubator programs, and with other investors in these other pockets around the country, that a lot of quality referred deal flows coming in. Now, we try to go out and source deals ourselves, but it's sort of a priority thing. When we have investors who have committed, saying like, hey, this is a deal I'm committing, do you want to follow on? Or entrepreneurs coming in saying like, hey, this is an amazing human being, can you spend 20 minutes with them? Like that's already one level of vetting. And I'm not, because we're not the big investor, I'm not taking the entire round. So I'm not competing with the Sequoias or Andreessens. Like they've got their own thing, or even like Primary Ventures in New York, like they're going to take the whole round. I can't compete with them. I can compete right before all of them go, which means like we're very collaborative with the other angels and small funds out there. We do take cold deal flow, but the problem with cold deal flow is it ends up at the bottom of the list because there's so much piling up when it comes to referred, and like so many people are saying like, hey, would you take a look at this? Would you, we've done deals together. Can you meet this entrepreneur? That cold just goes to the bottom, and it's a very, very quick cursory review, especially when it's just like a dear investor email. So for those of you who do want to go out there, my suggestion is, if it's pretty easy to find ways to get to the investors you're targeting rather than cold emails. Most investors are active in one way, shape, or form out in the networking world, or on social media, or they're putting content out there. And we have big enough networks that I'd be surprised if there's not a second degree connection with most entrepreneurs who want to get them. And that it should be pretty easy. But for those who can't or who don't have those connections, it's not as impactful to just send like a dear investor, I have a great startup, will you meet with me? There's got to be a little more thought to it, like, hey, and don't put it in AI, because it's easy to spot when it's an AI email. Like, I saw you invested in this, we're very similar. Well, that company failed 5 years ago, so you really just grab some logos from my website, or from PitchBook. But really do a little bit of homework, like, what's the thesis? Like, why are you aligned with who we are and what we do? Like, be a little more specific, and that email will get responded to, even if not immediate. Like, those are the entrepreneurs that I'm like, they spent 15 minutes doing homework. I can afford 3 minutes to respond to them and be like, okay, send me your pitch deck.
Absolutely. And actually brings up another point. I mean, you mentioned AI. So like, what are your thoughts on that? I mean, do a lot of your portfolio companies have a big focus on AI?
So in the startup world, AI has been around for a long time.
Yeah.
It was just 2-ish years ago that it was all of a sudden everybody's pockets and accessible. But AI, machine learning, it's been there. So a lot of our companies now they say, like, yes, they're doing AI, but they were doing it before. They just weren't saying AI. They were saying machine learning or proprietary technology, whatever. Nowadays, I think AI is so commonplace that most startups have to leverage it in some way. Now, that doesn't mean that it's the critical piece to building the company, or to the technology, I should say. But most people are figuring out ways that they can leverage AI to save on headcount or to save certain things. As an industry, though, I think there's way too many also AI companies. And we saw this with Uber, Airbnb, with Groupon. Like, all of a sudden, back in 2009, there was a Groupon for everything in every demographic for every product out there. It was nuts. We saw this with Uber. Like, there was Uber for, again, every locale, every like specific demographic you wanted to find suddenly had an Uber that they were signing people up. But it just didn't work. Those are not sustainable businesses to create hard little niches within. And Uber and Lyft and all the other ones ended up taking the market share. So that's the general commentary on.
Great, thanks.
And it's true, just as investors are accused of being lemmings, so are founders. It's true, they go gravitate. Oh, everybody's investing in this. It's like suddenly everything is AI. If you have to have AI somewhere in your pitch deck, or investors aren't going to write the check. No, you have to have a good.
Bonnie,
Go
how
ahead.
many people years back had to put the moniker web-based? Web-based. So
Right.
now it's AI.
It was crypto for a while too. Don't forget the blockchain crypto stuff.
Exactly.
Yeah,
Yep.
we do go through those phases, don't we?
And every now and then we'll get a pitch deck that we can play a startup bingo with, and they mention every single thing. I'm like, if you're doing that, then you're doing nothing.
Right.
Bonnie, how do you and Jonathan know each other? I mean,
really?
I know you know everybody on Earth, Bonnie, but
I don't remember. Where did we first meet, Jonathan? Was it ERA? Or before
I
that?
don't know, Bonnie. It was 10 years ago,
I
probably.
know it was a long time ago.
I'd have to search my email.
That's true. And whenever I see a new face in the room, I'll go up and I say, "Hi, who are you?
Yeah,
What are you?"
you are good at that.
Excuse me?
You are good at that. Yeah, I have no idea. I'm sure it was at an event in New York, and I used to be better at attending events, several a week. But I've gotten a little lazy at that these days.
No, I think we've gotten spoiled because we managed to do, no, serious, because we managed to do business, we managed to network without having to go through with transportation, this and drag around from here to there. I remember in the web, I have this terrible cold, my apologies. In the Web 1.0 days for the holiday season, I was going to 5 to 7 parties a night. It was insanity.
Yeah.
It was insanity. So I have a question about follow-on funding. Since we know you do keep some dry powder, but when it comes to and if you have a company, a portfolio company you really believe in, and I know you're well connected because I've known you for 10 years, would you make introductions to other funds and investors you know?
Of course. That's an easy answer.
Yeah, that's an easy answer. I don't know. I have an investor friend who said, I know some investors are leery of that because they're like, losing money, so let me pull you in and maybe you can bail me out. So I'm just telling you the things
No, we would look, it's got to be right for the investor and for the company.
Right.
At the end of the day, this is a reputation business. If
Yes,
I
it
blow
is.
my reputation by trying to sell something that's not doing well to another investor, I'm not going to get any more deals, and they're not going to take my next call. So, because this is not a short turnaround transactional industry, this is long term. So if I make a mistake like that, and I knowingly make an intro to an investor, I'm not forthright about how the company's doing, like it's not going to be good for me.
That's true.
So yeah,
Reputation's
like
everything.
yeah, the company has to be doing well. And I put homework on the company, like, why is this the right investor for you? Tell me more about that than like, here's the list I downloaded. Which ones can you introduce me to? Like, no, be a little more thoughtful. Don't just blast everybody.
Absolutely. Next question. Anybody else have a question or
No,
a
I
comment?
just wanted to say thank you, Jonathan, Bonnie, and Joseph. I have to run. I'm over on a next meeting. Thank you so much.
No problem.
Everybody had to leave for meetings. Suddenly, I had the two people who emailed me this morning. They had last minute meetings, so maybe people are writing checks again.
Maybe, hopefully.
A lot of investors I know were saying that they're waiting for the outcome of the election before
Yeah.
they're, and that it's true, everybody's in meetings again.
Yeah.
Yeah, I have another question.
Sure.
So Jonathan, do you ever recommend team members to your portfolio companies? Personnel?
Yes, probably not as aggressively as you are asking about, Ian. But when there are openings, we do make intros that we can, or we put them in touch with networks or groups that may be able to help.
And what would you say is the success rate of those recommendations in a sense? How often does it work out? Does it not always work out? Or
I don't know. I've never thought about that, Ian. It's because I'm not getting them like daily or weekly, the ones that are really integral. So I'm thinking like recently, one of our companies was looking for a COO. So I put them in touch with, 2 or 3 people, and I'm like, this is a very critical role, but here are two or three great people. See if it works. I don't think any of them did, but a couple of them may have gone to a second conversation. So we don't, because we're a small team, we don't have like this platform team or community team that's constantly like looking for new resources. This is just like a little more as needed and as top of mind.
Right.
I would like to do more, but we have limited team, limited resources.
Right. Well, the other thing is you mentioned the difficulties in getting up to speed with remote work. I mean, I'm just curious as to what were the actual difficulties?
Most VCs hadn't ever used Zoom.
Okay.
Before March, April of 2020, like everybody had heard of Zoom, but the industry was not well equipped to do Zoom the way we are doing it now. Like, yeah, maybe we've done 1 or 2 video calls before, but it wasn't like what it is today.
Right, right.
And most people were still working from offices. Very few people were working from home on the regular.
Right.
It took the industry like several weeks, if not months, to just be like, okay, we can work from home, we can work on Zoom. And then finally, like, we can actually do diligence and trust people looking through a camera instead of seeing them in person.
Right. Now I can see, I mean, I've been working remotely for a long time. I'm using Zoom probably for 10 or 12 years. So I became very comfortable with it. So it always struck me as a little bit, but I guess it's different when you have a style of working where you're in the office. Yeah. Do you recommend that startups get data rooms? Some kind of a secure way for a VC to look at their data. I don't know. I know
you should have a data room. Now, whether it's you paying for the platform or you're just using Dropbox or Box or Google Drive, like that's up to you and the security concerns that you have. But you should have the basics of a data room so that when a VC asks like, hey, send me the diligence documents, it's easy to port it over and say like, hey, most of what we have is here. Let me know what's missing.
Got it. Yeah. Makes sense. And we're using Notion for that. So Notion has some support for data rooms.
Yeah.
Thanks.
Yeah. Again, we are not the big investor that says like you have to do it this way and provide it in that way. Like we'll be flexible. I'm not going to let that format be why we do or do not invest.
Makes sense. Yeah, thanks.
So it was after you became comfortable using Zoom that you expanded your geographic reach, though, too, right, Jonathan? As did many funds. Because you mentioned
it became a lot easier. It became a lot easier to expand the reach because I didn't feel like I had to fly to see them or they had to fly to see me. And it was also just by default, we were all of a sudden able to do Zoom pitches.
right.
So, you know, we before we're like, okay, let us know when you're in New York and we'll meet with you. You know, we'll take a phone call here or there, and then when you're in New York, we'll actually meet in person and then get to people. And then the final pitch would still have to be in person. So it wasn't. It became all of a sudden accepted to just work on Zoom and meet people that way and do diligence on Zoom. I still prefer to meet people in person, but the majority of the portfolio right now, I haven't actually met in person before we invested.
That was my next question. Have you subsequently met with them? Because there is a difference when you're all in the same room. There is a very different dynamic.
Yeah. I think all the local ones within an hour, 2 hour drive, we've found ways to meet post investment. And some of the other ones we've seen each other in industry conferences, like the company in St. Louis. I saw them when we were both in Chicago for a conference. The guys in Florida I haven't met in person. Well, the guys in Virginia I haven't met yet. But most everybody else I've seen somehow or way over the past couple of years.
You have to arrange to meet the guys in Florida when it gets cold in New York.
Yeah.
Good time.
Yeah.
So any other questions or comments? Or... Yeah, I'm burdened with this cold thing. I apologize for my.
You're good, Bonnie. No, this is all good. I feel like I probably got on too long.
No, it's fantastic.
It's great stuff. I mean, well,
Jonathan, when you meet with people in person, do you have an office like in North Jersey? You said you go into the city sometimes, or do you like arrange, meet like at a place for coffee or something like that?
Yeah.
Yeah.
We meet at coffee shops.
Yeah.
There's
I love doing
always like friends who have office space that I can use.
Okay.
If we have like a really deep, in-depth meeting that we need a private room. But more often than not, like it's more of getting to know each other socially,
Right.
than really digging into things when we're meeting up in person. So, yeah, I'm trying to think if we've done any like deep diligence in person.
Hi. Yeah, I've had a super quick.
Oh, Andrea.
Yeah.
Andrea.
Oh, sorry. Hang on. Yeah, I just have a super quick question.
You should introduce yourself first, Andrea.
Companies using AI. Are you able to hear me?
Yes.
Yes.
It's a little muffled.
Okay. Yeah, so more and more I'm seeing funds that have built for themselves and or
You're,
to test some of the not, but
I'm not getting that, Bonnie. Are you?
no, I'm not getting it. I thought it was. Oh, Andrea, you're very muffled. Are you wearing like? Maybe you should.
Okay.
You want to put the question in the chat?
Sorry, I don't
Yeah.
know. Okay, hang on.
If you're using a headset, it's always worse. You want to try again or put it in the chat?
Yeah, it's not.
Oh, feel free to put it in the chat. We read.
Two working from coffee shops. I think early actually in 2020, my partner turned to me and he said, you know, we had office space in Montclair, New Jersey at the time, and he said, Jonathan, we're only seeing each other once a week because he was running around and I was running around. He's like, why are we paying thousands of dollars in rent? He's like, we're getting rid of it. And I
Yeah.
fought it at first. And then I'm like, it makes sense. Like, why are we doing this to ourselves and, you know, paying this cost when if we really needed, I could just go to his house or we
Yeah.
could do something like that. And so that's kind of what we've been able to do is, yeah, it's myself, my partner, and we have one key team member who we actually just promoted her to principal. So it's the three of us, and she's moving to upstate New York, but it's close enough where if we need her for the day, she'll drive down.
Yeah, I like doing that too because there's certain things when you're meeting someone in person like that that you can get, you can't get. You know, you just see how their behavior is, how do they treat the staff that works there. You know, just things like that might give you insight to their personality on what kind of person, you know, what kind of person they are, and it can be very different in person than on, you know, on Zoom.
So we used to do the French fry test.
Oh,
So
That's the French fry
we-
test.
So this came up because we took an entrepreneur out to, it was a diner in the city, Bonnie. Like, I don't even remember which one it was, but it was like, we need to meet a central location. There were 3 or 4 of us going. We're like, this is the middle ground. We're going to this diner. It was just meant for a meeting facility. And we picked like lunchtime or breakfast time. And we're meeting with the entrepreneur. We're in deep discussion. He sends his French fries back 3 times. I'm like, what is going on?
Whoa.
And like he wasn't that by the second or third time, he wasn't nice about it. And we're like, dude, who cares? Like you're sitting here, we're in like deep discussions. I don't remember if we were in the financial conversation or like talking about terms of the round. I'm like, what does it matter? Like, deal with your French fries later and like be nice to the staff. Like the waiter, you're yelling at the waiter, he's not the one who cooked it.
Yeah.
And so that's when we realized, like, yes, you're absolutely right. The way they treat other people is very indicative of how they're going to be as a leader and how they're going to show up. And so, yeah, that's part of the social things that we're looking at, the social cues. Again, wish we could do that more. You know, but it doesn't behoove us to fly all over the country to make these investments just to see how somebody acts in a coffee shop or at a restaurant.
Well,
Hopefully
I
we'll
I never understand like what he said, like you said about him, like I've never yelled at, I don't say never, but in last 20 years or so, like I've never gotten angry with the server, like about the food, or sometimes like call in, like we have a place in Ocean City. I hate the mortgage company we have. Every year I have the same issue. When I call, I tell the person on the phone, look, I am not angry at you, so I'm not going to yell at you, but this is my frustration because I do feel bad for the person who's like the messenger. You know, I don't want to yell at the messenger or if I have an issue, you know, you're talking and most of the time that doesn't get you any good results anyway, you know, yelling. So
that's the difference between you as an experienced entrepreneur versus somebody who didn't end up getting funded.
yeah. And
So
Andrea's back. Look, Andrea always looks like she stepped out of a fashion
Yeah.
magazine every time we see her.
Thank you. Thank you. Thank you. Very kind of you. Okay. So a super quick question. Funds are now claiming that they're using technology that they've built themselves and or have taken from outside, companies to help them figure out which companies are more likely to succeed and thereby to them initially and or to plow more capital into some of these companies that whose metrics, whether it's velocity or other interests. So I'm wondering if you're doing that yourself and or if you see the value of that kind of claim or technology.
So I want to make sure I understand the question, Andrea, because it did come in a bit wonky. Your question is around VCs using technology to source for new deals and to due diligence. Is that correct?
And to maybe double down and go in a subsequent round.
And to make what?
she said in subsequent rounds, something about from what I could.
Okay. Andrea, can you hear me?
Yes,
Are you back?
I can now. Yes. Sorry.
I think
Yeah.
Using tech to do source companies due diligence and make considerations for follow-on rounds. Is that the full question?
Yeah. Yes.
Okay. So there are a lot of firms that are creating proprietary ways of sourcing. And some of them have really great ones, like they find ways to look at all the new businesses launched in a certain area and go and figure out whether that's a tech company or not. And so they'll like just ping them. They'll work with universities. So there are firms that do a lot of that work, or that they've built their own tech. There are companies that will introduce deals. I find that difficult to sign up for because I think that the best entrepreneurs can probably get networked to the VCs and investors they want. It just requires hustle. And totally outsourcing the hunting is at seed stage. I don't even know how the math would work for the introducing agent because the startups don't have a lot of capital to pay. And if you're a broker dealer, you want to be working on 5, 10, 20 million plus deals, not 500 to 2 million. You're not getting a whole lot of the fee. And investors don't want to have the money going towards fees that they're investing. Because if it's 10%, that's a reasonable amount of money that maybe a full month's worth of burn, but it could be a significant new add to the core product, or it could be even a week of burn, or it could be like the bonus that will get you over the edge to hire the CTO. So invest at the pre-seed, seed, and kind of Series A, like up to really 3 to 5 million in fundraise. It doesn't make sense to use a broker. Again, there are platforms that will claim to make matches, but I don't know how much better those matches are than what we're getting anyway. Our network is pretty deep. For entrepreneurs, again, it may help to get them started. So similar to the mentorship programs that somebody else brought up, it may be a way just to like learn and like go out and like, let me get on this platform. They're claiming that they're going to make introductions to me, and maybe it costs a little bit of money, but they'll help me get my data room set up, or I'll get some. Andrea, go ahead.
Okay.
I'll continue.
Okay, cool.
When it comes to diligence and making investment decisions for the follow-on, I think the industry is starting to figure out how to leverage that. The biggest issue with diligence is the proprietary nature of the information that we're getting and putting it into ChatGPT or Gemini or any of the other AI platforms. It's like, well, which ones can I leverage that I feel confident and comfortable that the entrepreneur is not going to get upset, and which ones are truly like keeping information private. And I think that's probably where we're going to see a lot of ingenuity over the next 6 months, because we're actively looking for those kind of platforms that will help us aggregate data, summarize data that's proprietary. There are a couple firms that for many years have been using technology to make investment decisions, but they built it themselves. The main one is Correlation Capital. And they look at certain signals like who's the lead investor, what's their track record, and I think they even scan the social media profiles of the founders to see how deep their network is, something like that. So that's why it's called correlation, because they've developed an algorithm that like will correlate if you have these specific benchmarks of investors, of network, it's going to lead to a higher rate of the next round of financing, which will lead to it.
That was such a brilliant dissection of the issue. And now I'm kind of curious because when we zoom out and we look at what quant maybe algos and that kind of technology that have helped hedge funds trade better. So it's become a game where there's very little inefficiency, right? Because different. I'm wondering as that starts to come into the venture world, and as much as I agree with everything you said, but I also sometimes look back and kind of look at how the venture capital space has been performing or not performing. And most funds, even the household name ones, if you look at some of their numbers, it could be better, right? In as much as 2 out of 10 wins are still considered super amazing, as long as those are outsized enough to justify cover the sense of all the other ones. I just have to believe that there's still a play to be had where the machine, AI, machine learning can come in and maybe do what humans can't do, which is very lie to. As much as we like to think we do a good job. I knew FTX a little. I mean, I knew Sam a little bit, for instance. I don't know that I would have immediately have noticed something was wrong with them. I mean, something was wrong with the. Anyway, it's just to say, how much of a role do you think AI could play in the venture capital community in terms of that's just the. Yeah.
So in the short term, the next handful of years, I don't see it disrupting the industry in terms of replacing, the partners. I think it's going to probably in the short to medium term replace a lot of the analyst work. Doing research, putting together reports, summarizing things. I think that's the key area that we'd all love to have done by somebody else. But when it comes to the people, I think right now it's still a people industry, and I don't see that going away in the near term. And maybe that's me being defensive of my own role, Andrea. But I think that the two areas that AI is not ready to take over, one is that gut instinct and the empathetic, emotional, qualitative data that I was talking to before about, like, these are the leadership assessments we use. And it's to back up or go against what we feel, like our gut. And so in venture and in angel investing, if you've looked at any of the ways to set valuations on companies, there's always an asterisk at the bottom that says, well, how do you feel about it? What do you think the valuation should be? Because there's no way to put a formula to valuation because there's no historical data, especially to a new entrepreneur coming up, Andrea. So like, think about a 20-something-year-old entrepreneur or a 30-something-year-old entrepreneur that maybe has some industry expertise, but has never started a business before. How is AI today? Maybe in 5 years, they might have some qualitative metrics they can, but today going to be able to understand if this person has the mettle to really do it. So I think that's still a little ways away. And the second part of it was the network, because we all know each other and we're walking people to the others rather than saying like, hey, you need to make this connection. So I don't, the short term, I don't think it's going to be disrupted the way it could be.
I wanted to add something to that if you don't mind. Because, I am a super connector and I tell people I can see around corners, and I advise different startups. And, I was approached by a founder, and yes, I am advising the company. And there's another company I'm advising. They are two totally different businesses. They really have nothing to do with each other unless you can see around corners. And I introduced them. As soon as I explained it to them, then they could see what I could see. They partnered up, and both businesses are. It's been a complete game changer for both businesses, and AI could not do that.
I don't want to speak for the future of AI, Bonnie, but that serendipity is very much part of the industry.
Yes.
Yeah.
And I think Reid Hoffman had a great Masters of Scale podcast around the concept of serendipity.
Yeah, he did.
Like, yeah. So, and that's true. Like, I don't know if AI can really take over that, like accidental bumping into things and being put in situations where you create your own life.
You know, speaking of accidentally bumping into things, and you know, I was at a networking event. And there was a guy in the room who I didn't know who he was, so I went over to him and I said, "Hi, Bonnie. Who are you, and what do you do?" And it was Reed Hoffman, and he was just
Wow.
and so I helped him with his talking, but we ended up working together on his talking points from LinkedIn, and he got funded.
Wow.
But tell me that, Jonathan.
That's awesome.
Talk to people. You just never know who they are. You just don't know who they are until you
So
ask.
eventually, Andrea, maybe it takes over, and I have to evolve into something else. But I don't see that in the next handful of years. I think I can squeeze in one more fun before AI takes over.
Okay.
Yes.
Yeah.
Okay, I love that.
Well, this was fantastic, and thank you for
So-
spending a few extra. Oh, go ahead, Andrew.
No, that's it. I was just agreeing with you when you said it was fantastic. I was just saying, yeah.
Thank
I
you for
have a
go
good
ahead.
example of AI. I mean, I love AI and I think it is extremely useful tool used, in the correct ways, but it's not the main thing. And I read an interview, or actually a review. There's a new movie with Tom Hanks, I don't know, where they use AI, this program they have that can age you or make you look younger. And they use this with him and his co-star to make them look young. And it worked really, really well. But the reviewer said when he watched the movie, he would have rather had seen them with makeup because as good as the AI was, all those little nuances in
Yeah.
the expression and the emotion weren't quite right. And he could see it. So, that's like, you just got to make sure that you know what the tools are and don't let the tools overtake you.
Yeah, it's been said that AI is not really good with fingers and years.
Yeah.
So right now you
Yeah.
can kind of still tell, but it's just gonna get
Yeah. They got
better
like
and better, right?
all
Right.
these fingers and yeah.
Although
But I
Anne
wonder
Boleyn,
why. But yeah, I'm not sure why.
hands are a special problem. Although Anne Boleyn had 6 fingers on each hand, so who knows? You never know. So, Jonathan, any parting words of advice? And I appreciate you taking extra time with us.
Yeah, thank you.
And do you want to share your contact information? It's up to you.
Sure, I can stick it in there. The closing advice is startups are hard. That's why not a lot of people do it. But taking that first step is the most difficult part of it. And so for those of you who have started, congratulations. You're well ahead of everybody else. And for those of you who haven't, it's worth just jumping both feet in and taking that first step to keep it for you because there's never going to be a better time than now. Always a bad time to start.
Yeah, you're right. Thank you so much. And if you
Thank
want
you.
to just
Put my email in there. For those who do reach out on LinkedIn, just remind me that you met through here.
yes.
Otherwise, it's hard for me to kind of track down how I know people. I do try to keep my LinkedIn curated a bit to people that I'm comfortable recommending.
Yeah. I actually just sent you a request on LinkedIn, but
All right.
I don't think I put that we met on here. So if you see it today, you'll know it's from here. Yeah.
All right.
Yeah. And a
Thanks,
good
Scott.
place, a good diner. I'd love to meet at a good diner just to have a little chat with you. And I love diners. I'm glad I'm in New Jersey just for the diners.
But don't order French fries.
No.
I'm just
I'm
curious
going to order
that
the fruit.
yeah,
I have to order the fruit cup now. The
I'm
French fries
curious.
go right to the middle.
I'm curious after that the founder's behavior at the diner, did you end up investing or did you find was that a big red flag?
So it was a red flag. We ended up giving
Yeah.
a term sheet, but we never ended up investing for a lot of reasons, and that was one.
Yeah. But that really
all right.
was telling too.
Thank you, Bonnie. Thanks for having me.
Thank
This
you
was a lot
so
of fun.
much. And thank you everybody and enjoy the rest of
Bye,
your day.
everyone.
Bye, everyone.
Thank you.
Bye. Bye.
Okay. Bye-bye.